Okay, if you can take your seat in order to start the next session, please. Thank you. So let me give now the floor to our chair, Arend Kapteyn, who is a global chief economist from UBS, and we are going to look now at the global economy, and we have an excellent panel. Arend, you will just introduce briefly our speakers. All the bios are on the website. Arend, thank you for joining. Over to you.
Thank you, Mark. So yeah, just we're going to talk about the global economy, and we'll focus a little bit on sort of just the basic outlook, and then talk about sort of our inner fears and the type of things we're worried about. So to join me in doing that, on my far left, I've got Jason Wu, who's the assistant director at the IMF, and basically has the Global Financial Stability Report with him. So we'll talk a little bit about that. Giammarioli Milesi-Ferretti, who's currently senior fellow at the Hutchins Center on Fiscal and Monetary Policy, also former deputy director of the research department at the IMF. Then to my immediate right, Albert Park, chief economist of the Asian Development Bank, and on my far right, Nicola Giammarioli, who's Secretary General at the ESM in Europe and a member of the management board. So with that out of the way, let's get straight into it. So we've just had the most synchronized tightening cycle by central banks in decades. We're now going into what looks to be a synchronized easing cycle. But we're still nearly at full employment. Inflation hasn't really come down. And if you look at what the markets are pricing, they're effectively pricing a regime shift where, for the developed markets at least, real interest rates are hundreds of basis points higher priced for the next couple of years than they were pre-pandemic. So that raises all kinds of questions as to where we're going. And the first person who is going to opine on that is Giammarioli.
Thank you, Arend, and thanks, Mark, for inviting me to this event. So I'd like to start just to making a few observations about this synchronized recovery as compared to previous ones, and to see whether there are elements there that help us understand better where we stand and where we're going. Clearly, a very synchronized recovery after the very, very deep downturn, but this was not a downturn caused by endogenous imbalances in the system. It was a downturn caused by a pandemic and the policy response and the decisions to shut down economic activity. So in that sense, with the pandemic receding, a swifter recovery exposed makes sense. Clearly came with a lot of other things at the same time. It came with structural changes. We are still struggling to understand those. And clearly came with a resurgence of inflation. But if we want to think through where we're going, I think it is important to focus also on what these structural changes are and whether they differ across different regions. I mentioned just a few: impact of work from home, impact on labor force participation, the composition of the workforce, what is going to happen to commercial real estate, to cities, with increased work from home. On the supply side, does this imply more tradability for services, more access to labor residing elsewhere? And overall, also a very different policy response across countries. And here I'm coming to the issue at hand. I think we tend to lump, because of the commonality of the inflation experience, given the nature of the shocks that triggered it, we tend to associate what is happening in the US, what is happening in Europe, and sort of treat them in a very similar way. But there are very deep differences in the type of shock, in the way that the shocks have impacted the two economies, and in the nature, in my mind, of the inflation roots as well. So for Europe, you had a massive external energy shock, which was associated with a very large terms of trade decline, a transfer of wealth abroad, a substantial weakening of domestic demand. As the shock wanes, the inflation rate has come down. There is stickiness in inflation in services, but you have to think that real wages took a huge downward hit, and there is some recovery in nominal wages and real wages that is likely underpinning this pressure, because domestic demand is contained. And hence the odds of very sizable persistence of inflation pressures in an environment in which the economy is barely growing is, in my view, modest, and hence cuts more likely. Clearly, the outlook in the US is different. The strength of domestic demand is of a different nature with regard to Europe. It's underpinned initially by very large fiscal stimulus, but also by very favorable asset price dynamics, and by the fact that while Europe experienced a massive negative terms of trade shock, the US experienced a very large positive terms of trade shock. People don't talk much about the terms of trade in the US because people think about domestic sources of everything here, given that the economy is not super open in terms of ratios of trade to GDP, but we're still talking about almost 10% improvement in the terms of trade for the United States. That is a sizable number. And some of the shifts in the global economy, think of demand for LNG, the US exporting it, think of the increase in military spending, again, where the US plays a big role in production. All those factors are factors that affect Europe and the United States literally with the opposite sign. So here, the persistence of inflation with very strong domestic demand is in some way something easier to understand. Where this is going, I still think inflation is still likely to be on the way down, but clearly the path for nominal interest rates is uncertain. And if I have to think about ways in which things could go better or worse, I would have to think about a change in market expectations about the persistence of high interest rates that could dent very rich valuations of asset prices with the consequent repercussions on domestic demand. But overall, if I look at the global picture, and we're going to come back to this, I think, after in the second round of questions, it is not so much standard economic vulnerabilities that are my biggest source of concern. My biggest source of concern is everything else. Is a very fraught geopolitical environment. It is what is happening in the Middle East, what is happening, the war, the Russian invasion of the Ukraine. There are so many potentially risk points that could trigger repercussions for the global economy and I forgot about the election in the US in November, that give us a lot of pause. Last remark I would make is that this set of risks and this difference in the way shocks have affected different countries is reflected in an environment where it's much more difficult to make general statements about the outlook. I dwelt on US versus Europe, but clearly you have issues with the strategy chosen by China away from the rebalancing towards consumption and more towards supporting manufacturing activity, what implications that will have. We have a very mixed picture in the emerging world, the large EMs doing generally pretty well, but a number of second-tier EMs in terms of size really struggling, and the low-income countries in severe difficulties. So it is, again, a very different outlook for different sets of countries and a complicated picture. The aggregate numbers for growth are not stellar, and that reflects primarily the fact that the EMs have not really fully recovered the pace that they had before the pandemic. Let me stop here and
actually one follow-up. So with the caveat that you're right, you can't sort of generalize and everything is different. I'm going to try to get you to make a general comment. So if you characterize the sort of the pre-pandemic period as one of being, low growth, low inflation, how would you, and the dust is still settling, so we don't quite yet, we haven't completed the full cycle. We don't quite know yet where we're going to land. But what is your best guess, sort of, let's say, 2 years out? Are we moving to just going back to a low growth, low inflation environment? Is it going to be a low growth, higher inflation environment, or is it a higher growth, higher inflation environment?
The easiest prediction, I would say, is on the growth side would be lower growth, and I say this in a baseline because of what is fundamentally demographics, and I think of some of the global engines of growth slowing down. I mean, China being a case in point. There's lots of ink being devoted to this issue. The World Bank Global Economic Prospects had an issue on, a big volume of potential growth. The IMF stresses the same things. Of course, the one element that could change the picture is productivity, and everybody talks about AI. Seeing its effects materializing across the board in a very quick way, in a way that is detectable in macro data at the global level, I am skeptical. In the short run, I'm fully cognizant of the fact that this could be a major shift down the road, but I think it's hard for, say, the next 5 years to predict a boom in global growth because of this, but I hope I'm wrong. On the interest rate front, I'd say there's a whole debate on our star. Again, I would not take any definitive position on this. I think everything we have learned is that we have to be very humble in making forecasts. So I would say there are clearly forces that have pushed interest rates up, and I would list the obvious ones: more deteriorated fiscal situation, the resurgence of inflation. I think inflation is waning, but clearly the notion that inflation premia are going to go back to pre-COVID levels is harder to sustain, at least for the next for the more immediate future. And you have higher demands for investment and spending in a number of areas, energy transition being the most obvious one. So you have all those forces. They were there in some way before COVID, but they are forces that may be pushing towards higher investment demand globally and potentially push up interest rates a bit. But I think certainly the levels that we see now are more related to getting the inflation out of the system than with sort of a permanent increase in steady state interest rates, even with a weaker outlook.
We're going to turn to Albert. So actually, this is the week where we all read the WEO and the GFSR. But actually, last week, the ADB published their outlook. And it's actually it's got incredible detail on Asia, and I really recommend everyone have a look at it. Albert, your outlook specifically for Asia.
Sure. Thank you very much. So we're forecasting fairly robust growth in Asia. ADB, in our outlook, we cover 46 economies spanning from Central Asia and Caucasus through South Asia, East Asia, and Pacific Islands. And our forecast is that growth will be 4.9% this year and 4.9% next year. And that kind of steadiness masks moderating growth in China, which we're forecasting to be 4.8% this year, a bit below the government's target of 5%, and then 4.5% next year. But offsetting that is that growth is pretty dynamic in other parts of the region. So we're expecting growth in the rest of developing Asia, not China, to increase from 4.8% last year to 5% this year to 5.3% next year. And here, the fastest growing economy is India, which we're forecasting to grow at over 7% a year this year and next year, on the strength of pretty high levels of infrastructure investment, deregulation, a demographic dividend, and recovering demand. Rural areas had a bad year last year because of poor weather, but are coming back. And then the other region that is dynamic is Southeast Asia, and the highest growing economies in Southeast Asia we're expecting to be the Philippines, where the ADB is based in Manila, and also Vietnam, both at about 6%, and then Indonesia not doing too bad as well at 5%. If you look at what Asia is contributing to global growth, we estimate that it will be, over the next couple of years, accounting for 60% of global growth. And China, despite its slowing growth, still will account for about 30% of global growth. And India, which is rising in importance, will account for 17% of global growth. And it's, I think, worth noting that there's a recent IMF study that also pointed out that now the emerging market countries in the G20 account for about the same share of global GDP as US, Europe, and Japan, and also that shocks coming that hit the large emerging markets have about the same size effects on other countries as shocks to the US, Europe, and Japan. One thing that has benefiting growth is a recovery in exports, although there's been kind of a bottoming out of the semiconductor sector and electronics exports in general that happened kind of last year, gradually recovered and has hit positive territory in the early part of this year. That said, global demand, because of slower growth in advanced countries, is still fairly weak. But obviously, in the semiconductor space, with AI, there's been a big recovery in demand. And there's a special report in the Outlook report that we issued on the semiconductor chip sector. And it's important for Asia because 80% of chips are produced in Asia. And we note that the types of chips that are important for AI, the advanced processing chips and memory chips, are the ones where we're seeing much faster or more accelerated growth and increase in exports. And the one country that benefits the most from that because of what they specialize in is Korea. Taiwan less so, even though, of course, they're producing high-end chips, but they're producing a lot of other not so high-end chips. So they don't benefit disproportionately. Maybe I'll stop there. Thanks.
Let me ask you one question about trade. So one of the things that's puzzled me is, so you rightly highlight this improvement in the tech cycle, and that box was very nice. But then at the same time, you look at sort of the aggregate momentum in global trade is still very lackluster, right? And so one of the puzzles for me when I look at the trade data is it looks like Asia's trading with itself, right? You sort of, and so how sustainable is that? I've always sort of operated on the notion that ultimately whatever is produced in Asia has to be sold somewhere else, but that doesn't. Is that just a lag? Like we're just waiting for that to go through the chain and then?
Yeah, and just to be clear, I think the resilience of growth in Asia is on the back of domestic demand, not so much trade. Although it's much better this year than last year when export growth was negative for all of the high-tech exporters in Asia. So one thing that we like to emphasize, I mean, and by the way, the Asian Development Bank from its founding has really been a strong advocate of regional economic integration and open trade and investment. And I think that is still generally the view of pragmatic leaders throughout the region. Obviously, Asia has benefited greatly in the past from open trade and investment. But in the current global context, what that has meant is what you say. There's kind of more deepening regional economic integration. And even if you study the patterns of supply chains, you're starting to see that more of the supply chains now being within the region, especially with China, than global because of all of the growing barriers that we're seeing. And there is a pretty good diversity of countries in terms of level of development, the cheapness of labor, et cetera. So there are opportunities to have gains from trade within Asia. And of course, China is such a large economy now that it can It's become a really important part of many global value chains. Part of it also is, trade diversion we're seeing because, China's now investing in Vietnam and in Mexico and other places that are viewed as friendly to the US so that they can evade the tariffs and diversify risk. And so you see that in some third-party countries, I think, will benefit from that. But of course, globally, still we think, the trend towards industrial policy, protectionist policy, fragmentation of global trade is really going to hurt everybody. I mean, that's I think a classic view of economists, but I think we're seeing lots more. We're going to see a lot more misallocation and inefficient activity going forward.
We're going to come back to China and that particular issue in a bit. Jason, so the Global Financial Stability Report, I think, hopefully I'm not taking it out of context, but I believe it said that the financial risks have receded somewhat, but that you also still see fragility sort of in this last mile of disinflation. So can you sort of walk us through the basic narrative?
Thank you, and good morning, and thanks for having me here today. Arend is exactly right. Our assessment is that near-term financial stability risk has receded. Let me explain this a little bit. And by the way, our job is to worry, so I'm going to focus mostly on the downside and be a little bit of the party pooper here. So when we started with this edition of the report in January, markets were very exuberant. Everything was going up. I think there was a press conference in December by the Fed that really, in our view, underwrote the 7 cuts or 6 cuts or however many it was predicted at that time by markets. And everything was going up, Bitcoin, stocks, you name it. And so we were impressed by this easing of financial conditions in light of the fact that global interest rates were at the highest level they have seen in a couple of decades, right? So that, together with the fact that some cracks that we have seen in the financial system having not ruptured further, that is the basis of our assessment that financial stability risk in the near term, and I highlight in the near term here, has receded. And so these cracks include, the banking turmoil, right, around a year ago, having not metastasized further around the world. It also includes the fact that emerging markets, as both Giammarioli and Albert has mentioned, have been very resilient, shock after shock, and yet it seems like capital flow volatility, exchange rate volatility were fairly contained. So on that basis, near-term financial stability risk has receded. But on the other hand, I think there are a couple of things that we worry in the near term as well. With asset prices being the way it was, recent few weeks notwithstanding, it's reasonable to question whether things are overvalued. And so in our report, we dug into that in a number of asset classes, starting with stocks, but also credit spreads. To give you an example, we have a credit spreads misalignment model. This is basically comparing US and Euro area IG and high yield spreads against fundamental values. In other words, default probability based on available balance sheet data that we can see from corporates. And both US IG and high yield are at 0 percentile of the historical distribution, meaning that misalignment has been as large to the downside as we have seen historically. And in Euro area, things are a little bit better, but it's still hovering at the low 20s to 30 percentile in terms of misalignments. So together with other measures like excess bond premium, this basically paints a picture where valuations are quite stretched this time in the credit cycle when we take into account the fact that spreads are very compressed. And of course, in the stock markets, we use things like equity risk premium, and we show more or less the same picture, although the exuberance is not seemingly as high. So with asset valuation being stretched, this is one of the classical dimensions in financial stability assessment, right? The fear is that when things are frothy, then you have the sudden repricing that could arise, based on a geopolitical event, based on upside inflation surprises, which we have seen a little bit in the US recently. A myriad of whole things can sort of snap that around. And so when that happens, asset prices sell off, volatility increases, and then some of the cracks that we have been concerned about may be opened up some more. For example, CRE was mentioned by Giammarioli a while ago. I think that sector is certainly not out of the woods by any means, right? There is still a weak tail of banks globally. In the US, the regionals, for example, but in China and some other economies, we also find that certain banks are not looking as robust as they were before the rate hikes, right? And related to CRE exposures, perhaps, but also a myriad of other factors like credit exposures more generally. Those are also financial stability concerns that we might have in the near term. So even though things are looking a little bit better, I think our point is to be the party pooper here and point out that there are a number of risks on the horizon. Finally, I would just say that in this easy financial conditions environment, we are also about more medium-term vulnerabilities being built, being built up, and in particular, debt, both government and both private, as well as in advanced economies and emerging economies, are in fact stealthily rising. Perhaps in the government area, in the government sector, it is more obvious that that is increasing, but also in the private sector, our report tried to look at a number of sectors where that has been accumulating, and that's obviously more of a medium-term financial stability concern. I'll leave it here, and maybe we can discuss this a little bit further.
Just ask you one question. Would the concerns that you have, would they largely go away if you were sort of guaranteed that inflation would come down and the central banks would reverse all the excess tightening that they've done?
Very good question. So, some of you may know that we base our financial stability empowerment assessment in part based on a tool that we have called growth at risk, right? This is basically forecasting the distribution of growth given where financial condition and credit growth is currently. And so to your point, Arend, if rate cuts are guaranteed and inflation were to come down, that easy financial conditions will continue to be the case. And in the growth at risk model, this means essentially that some of the financial stability pressure points will be alleviated, and hence some of the near-term fragilities will also be lessened.
Okay, great. Nicola, let's go to you. Where does Europe fit in all this? So we've got this unusual situation where the North is underperforming the South, right? That's for some obvious reasons, I guess, right? Because of the trade exposure and the energy intensity of some of the production. But so what's your outlook on Europe?
Thank you very much, Arend, also Mark and the organizers for inviting me. Very pleased to join this panel. I will start by saying that we have three things in common, myself and Giammarioli. So the first one, both are Italians. Second one, we overlapped for a few years at the IMF. And the third one, that what he spoke about a minute ago is exactly what I prepared now, so I can stop here. But since I give a focus on the euro area, maybe I can find nuances that could still be interesting for you to listen to. So if you look at the WEO report that was just released, I mean, the number for the euro area looks pretty low. Last year growth was 0.4, this year predicted 0.8, and going forward 1.5, which is not too bad. But I would say that given the nature of the shocks that the euro area faced, and Giammarioli spoke about it, and the policy response, I would see the empty full glass, because we avoided recession, we showed resilience, and I will dig a little bit into it, and then I will come also to differentiation among the members of the euro area. So exactly as Giammarioli said, the nature of the shock or the effect of the price shock was completely different in the US and in the euro area, and this is due to the energy sector. And as Giammarioli said, the US gained 10% in terms of trade. The euro area lost 10% in terms of trade. This meant an outflows of wealth amounting to 500 billion euro. This is a huge amount. And if we look back at the oil crisis of the 70s, similar numbers led to a big recession. At the time also in the US, because the terms of trade at the time were similar between Europe and the US. In the meantime, the industrial structure and the energy sectors have changed a lot. The fact that we avoided recessions and also the fact that the US has been performing better is also due to not so far to different policy response, but the size of the policy response. On the monetary policy side, I think both economies had to face high inflation and the central banks raised interest rates. So I would say on that side, everything was the same. But on the fiscal side, and the fiscal side to do the job to counterbalance the shock, the deficit in the US was double the number in Europe. And if you look back at the numbers I quoted at the beginning, there has been a difference on average of 1% growth between the euro area and the US. It's not such a big number if you think about the size of the shock and the policy response. So I would say that euro area has been very resilient, and the perspective, the outlook looks relatively good. But I don't want to give the impression that the situation is so rosy. And I think looking at ahead, I would detect two major sources of concerns. One is the long-term trend that will kick in, demographic. I mean, we have in Europe an aging population. There will be a huge outflows from the labor force in the next few years. And with current policies on immigration, which are tightened, it would be very difficult to keep with the productivity. And exactly this is the second point, where productivity is going, competitiveness. So there's high risk going forward. This in a context of fragmentation, geopolitical risks, deglobalization. Euro area is pretty much an open economy, and the trade flows will have a big impact, or a bigger impact in the euro area compared to the US. And the final point and source of concern is what Arend, you exactly mentioned. I mean, these aggregate numbers mask a lot of differentiation among the euro area members or the European members. I mean, you can decide different line of divide, north, south, east, west, but we have a group of countries that are doing really fine and have a very positive outlook. Just a little bit of self-congratulating role of the ESM, those members that receive financial assistance, that they did reforms, are the best performing countries in the euro area. But you have big countries, including mine, that have big problems, low competitiveness, low productivity, low growth. We can have a spiral, low investment. So that's why, and maybe we can talk about it later, this not only is a toll on growth, but could be a source of financial stability risks. That's why it's important to address those challenges with appropriate policies that in our case in Europe are both domestic policy, but also euro area or European-wide policies.
Okay, so let's turn to some of the vulnerabilities and financial stability issues. So Jason, I'm going to start with you. You know, the conventional wisdom for a long time has been that the next crisis was going to be in the non-financial sector. And then last year we had effectively a traditional banking, I don't want to go crisis, but we had obviously the SVB wobble. Now, you've written a chapter about private credit. So I wanted to get you to explain a little bit what's in that chapter, but also did you write that chapter because you think that is the biggest risk right now?
Yeah, thank you. So the Chapter 2 of the GFSR this time is about private credit. And the main reason why we wrote it, to be very honest, is because we have noticed that it has gone from $0 to $2 trillion in 10 years. And so we are asking the same questions that we will ask about any non-bank financial sector, whether there is vulnerability in this form of credit provisioning. Among the 2 trillion, some of it is dry powder, but I think $1.5 trillion has already been lent out. And so the first place we started was to look at the profiles to the best extent that we can of the companies that were receiving the funding from private credit. And what we find is that these are generally smaller companies, between 500 million to $1 billion in revenue. The ones that are not large enough to tap corporate bond markets, but perhaps a little bit too large for one bank to lend to them, right? They don't also want to go into syndicated loan market. Which is why they reach out to the private credit segment of lenders. They are firms that usually have low revenue compared to their debt. And then they are ones where the interest coverage ratio, to the extent that we can tell, have declined significantly over the past 2 years because of higher interest rates, right? The conventional wisdom is that these are firms that are borrowing SOFR plus 500 to 600 bips. And so, you know, they are highly levered firms, and smaller ones, and perhaps newer in terms of their, you know, corporate cycle. So that itself is not necessarily a vulnerabilities, right? You know, after all, risky firms need to be funded as well, you know, in order for the economy to work. So we try to also look at other dimensions of vulnerability, including whether private credit is a sector that uses a lot of leverage to fund these lending to these firms. We find that in general, the capital tends to be little longer term, provided in a LP-GP type of arrangement where the LPs, are pension funds, insurers, and other institutional investors. There is longer lockup period. And, the use of leverage is present, currently moderate for those funds that actually use leverage. For example, they pledge the portfolio of loans and borrow from banks against them. Leverage is 1 turn, maximum 2 turns. And so currently, if you put this picture together, riskier borrowers, relatively moderate leverage, and modest maturity transformation, it seems like that the picture is not very concerning. However, I think our concern is, number one, we had to do a lot of digging to get to these preliminary and, dare I say, very sort of partial conclusions, right? That the opacity of the market itself, at least to the regulators and to some of our peers on the regulatory side, is one concern. The second concern is that risk appetite has been very strong for this sector. There's a recent survey of insurance and pension funds making the point that essentially this is the top segment that they want to, top asset class that they want to allocate funds to. And finally, while leverage and maturity transformation is modest at the current juncture, there are signs that they are growing, right? After all, it is a fairly profitable segment. It is a very hot segment, so multiple players want to be involved. And so the intermediation chain might become more complex, facilitating higher leverage going forward. So if I may very quickly summarize, I think we don't see it as a acute financial stability concern at this point, based on what we can see. But the opacity, the level of growth, and the general trajectory of the sector suggests to us that policymakers need to take note and perhaps start to, starting from closing the data gap, understanding the sector a little bit more is quite imperative.
Great, thanks. Albert, let's talk about China. Now, I'm going to ask you about China because that's sort of features in most of our client conversations as sort of a source of concern. But if there's something other than China you think we should worry about, by all means, tell us. So on China, they've for quite a while now tried to stabilize the property market, and it just still doesn't really seem to be convincingly sort of happening. How should we sort of think about where we're going? Does this have the ability to spin into something more dangerous? The financial sector is obviously quite exposed to not so much the developers, but certainly property and collateral. So what's your view on sort of the vulnerability that we face here?
Yeah, I get asked all the time about China's property sector. And the numbers, although the early numbers for this year for the Chinese economy as a whole looked pretty good, not the numbers for the property sector, where we see continued declining sales, declining investment, and even declining prices, especially in the smaller cities in China. And the Chinese government is trying to manage a pretty challenging task because it had a set of institutions that led local governments to be highly incentivized to pursue growth and to develop land because it was a source of revenue for them. And it's led to very severe supply-demand imbalances, a lot of empty apartments, and especially in the lower tier cities. It's interesting, though, that China's population is now shrinking in absolute terms, which means in the future you're going to see some Chinese cities shrinking and some Chinese cities growing. And obviously, it wouldn't make sense to have an all-growth, all-investment strategy in places where population is shrinking. And so that's kind of the challenge. They had these old set of institutions that kind of worked okay when demand grew to fill the supply, that had been built first. And I think they're aware of the situation, but to resolve that without really tanking the economy, they're trying to manage a soft landing. So they're trying to address some of these imbalances, allow some of the developers to fail, even not bailing out local governments. So there was a story where a bunch of provincial governors were literally negotiating with banks to to, write off some of their debt, local government debts as well. And they weren't getting much traction because I think the government leaders realized they need to introduce a kind of a discipline to change those bad kind of incentives in the past. The problem, in my view, is that to really avoid, just repeating the same types of problems in the future, once it kind of bottoms and starts to recover, they need to really reform the institutions. They need to have a local public finance system where local governments can raise revenues to meet local demands without going to property sector development. They need to really think about allocation systems for land, for capital, that really is much more efficient. I mean, the Chinese system now, there's a lot of successes. There's a very active state-led industrial policy, but there's a lot of inefficiency and misallocation in the economy. And I think it's going to be hard for them to regain growth momentum if they don't fix some of those problems. The government says that it's going to kind of bottom out the private sector by the end of this year. But I think if you look at the degree of imbalance in the second, third, fourth tier cities, it seems hard to imagine they could resolve all of those by the end of the year. So the result is they're trying to manage a slow kind of soft landing. But if they don't allow for a kind of a faster fall with prices and everything, then it's just going to be more painful, but for longer, right? Or they could take more pain on a short-term fix, or just kind of bleed out over many more months. And I think they're choosing to try to hope that it will somehow recover on itself. And they have a lot of control. I don't think there are like financial system risks in China. I mean, the people in charge really understand the nature of these problems and are managing them and have many tools, some of them very unconventional, to avoid any type of financial instability crisis, I think.
Are we right to think of China as the most important financial risk in Asia, or is there something else that we're missing?
I just think of it more as a growth risk, because so much of the region is connected to China. We have a rule of thumb that many people have, that a 1% growth in China is, creates 0.3% of growth in the rest of the region.
Nicola, so it seems like in Europe we've gone from crisis to crisis the last decade. So the peripheral debt crisis, and then COVID, and then the energy crisis. We got a war on our border. But there's also been lots of institutional change, right, to make Europe more resilient. So I'm curious if you could give us sort of a strength versus weakness assessment of where we now are, and what you worry about.
I think you are perfectly right. We have experienced in the last 15 years a number of crises, starting from the ramification of the global financial crisis into the European sovereign crisis, but then the pandemic, the energy shocks, and now the geopolitical risks. I think we learned that financial stability is at risk. At the same time, we have tried to build up resilience by deepening the monetary union and its architecture, and creating new institutions or strengthening the existing institutions. I mean, very rapidly, of course, talking my own institution was created exactly as a lender of last resort in case of a sovereign crisis, but it's not just that. If you look at the financial sector, in Europe, we have integrated banking supervision and banking resolution, for example. Also, in response to the pandemic, the European leaders launched the Next Generation EU, which was something unthinkable just a few years earlier, with the issuance of common debt to finance the green and the digital transition. This has created more resilience. But as I said, risks are around the corner, and I think there is a need to continue on this path. It's not a finished business. And on the fiscal side, for example, we had a build-up of debt that needs to be reduced. Buffers need to be recreated to address future crises from a domestic point of view. And the recent initiative that was concluded was the reform of the Stability and Growth Pact. Now we need to see if it works. I mean, there are all the preconditions that the new rules are more conducive to investment and growth. So focusing not so much on sustainability. Of course, sustainability is a precondition, but also having an eye on growth and investment. And more on the financial side, unfinished business is the so-called capital market unions, because we cannot pretend that all is solved by the public. We need private money, we need risk sharing, private risk sharing to allocate resources and to make sure that shocks are addressed not just by policymakers, but also by the private sector. Second initiative, I mentioned the single resolution and the single supervision, but the banking union is not completed. We need more resources to address liquidity problems. We need to support depositors in case of a crisis. And finally, if I may conclude, is to change a little bit the viewpoint. We have been working on crisis resolution so far. I think we need to invest more on crisis prevention. It implies having the right instruments and the right institution to detect risks in earnest and address them in a preventive way and not in a post-crisis way. To be more concrete, I mean, the IMF has reviewed the precautionary financial assistance last December. We're also working in Europe to make sure that we have enough resources to avoid that small problems here and then are transformed in big crises. I think this is the best way to contribute to financial stability. At least we try to do our part in Europe.
This may be a segue to Giammarioli, but so they recently approved these new fiscal rules. Obviously, one of the concerns we haven't talked about yet is public debt and whether it's sustainable and where we're going. What's your assessment of these new fiscal rules? Do you think they have more teeth in getting the debt trajectories to bend back down than the prior rules?
I think there's been a long process. Again, you can see the half full or the half empty glass. I think expectations were very high to create a very simple, transparent rules that are owned by the member states. I think we went in the right direction, maybe not the full Monty, but there's great expectation that I said before, those rules will be more owned by members themselves. They will create enough space to finance investment, which are much needed, at the same time safeguarding financial stability through debt sustainability. As a matter of fact, the debt sustainability analysis is becoming the anchor of the analysis. So this is more data-based than, let's say, prescriptive rule-based. And those analyses will be done country by country, so they will take care into account what are the needs of the various members, maybe also to address what you asked before, or what I replied that my concern is not just the area as a whole, but how the different members evolve over time.
Giammarioli, what do you worry about?
November?
Oh, sure, we can talk about that.
Sorry, I'm being. No, let me be non-partisan specific of what I mean. I think the challenges for global economy, expand borders. So I am very worried about any tendency towards isolationism, especially coming from the largest country in the world. And I think the cost of economic policy uncertainty in this country are very large across borders, and I honestly would have a hard time predicting what economic policy would be in regard to many of the issues we have discussed with a change in administration. Think of climate, a key issue. I think of security in Europe, another key issue. So that's, I would say, and you have then the actual, heat points in the world at the moment. The possibility of an escalation in the Middle East with repercussions for oil prices, which in turn have repercussions for the inflation process. They may even have repercussions for the election, given the impact on inflation. That's a major concern. Russia, Ukraine, and here, for Europe, we have challenges that go across borders. The big problems, climate, security, are problems that are not national, and it Europe is already facing a more difficult economic environment. I think it has done, as I agree with Nicola, many things in the right direction, maybe not with the speed we all wish, but things in the right direction. But these are huge challenges. They require common action. I think Mario Draghi's report is going to very much hammer on these issues, but the extent to which you will be able to have the political consensus to do this is uncertain. And we don't know 6 months from now, with the European elections and the elections here, what the global political environment is going to look like. I think, on a more prosaic base, the fiscal challenges are big. I mean, you need higher spending on the transition, you need higher military spending, and you have a demographic trends that clearly do not bode well for trend growth. It is a big economic problem. Don't see it as an immediate short-run risk, but it is clearly a big economic problem. But again, to go back to my initial theme, I worry more about the repercussions of all these, geopolitical tensions and electoral strategies in regard to international cooperation than I do about the risks that are there, but of purely economic nature.
Okay. Mark, I know we're sort of out of time. Do we have time for 1 or 2 questions? Or okay, any questions from the audience? Yeah, at the back. Yeah.
Thank you so much. Yolanta with Mount Pacific Group. Question for Jason. What are the potential spillovers that you could envision that could be systemically important from the private credit market? There must be an interconnect with the system. And the second part of the question is typically the crisis starts when the cash flow stops. If these highly levered companies will lose market access, that could have implications. Thank you.
Yeah.
Yeah, thank you. So the systemic spillovers, I think one area we're concerned is that the investor base is very much institutional. Then a lot of these funds are actually sponsored by companies that also have private equity funds, right? So the interconnectedness, in some cases we are seeing that the private equity owns the insurer, which then uses its balance sheet to purchase, to lend private credit, right, to the borrower. So this interconnectedness picture, we don't have a fulsome assessment of how a blow up could look like. We're hoping to get to that, but it doesn't sit very well with us that there's a lot of commingling, right, of risks in the sector now. And then to complicate matters further, I think banks are taking more active approach towards private credit through joint ventures, through lending to some of these funds. And so, as I said, there could be systemic implications further down the road. And, one of the shocks that can bring that about is if higher for longer were to stay, a lot of these companies will not have cash to actually service their debt. We are actually seeing a rise in the payment in kind type of debt servicing rather than actually paying off the debt as an evidence that, some of them are indeed struggling. Floating rate. Yeah.
It feels a bit like we're at the Oscars and the music has started playing and we're about, because the lunch is coming in. Any last question? Yeah.
Very quick question. Any of you are concerned about the US Treasury market stress given the amount of issuance that people would do short term?
Anyone who wants to take that?
I'll just say that we know in the report that the sensitivity of the market to U.S. Treasury auction tails have increased significantly since the post-pandemic era, because issuance has been very strong. Now, obviously, there's a little bit endogeneity there. The issuance strategy is based on how they think about the least risky way to get themselves funded, right? So I think they're also policy responding to the market's concern. But I do think that the reaction to Treasury tails is higher, term premia is higher, real term premia, which is reflective in part of the fiscal sustainability concerns.
Voshka, there was a client that showed me an article from 1972 yesterday and said, we're going broke. It was about the US. Debt to GDP was 34% of GDP back then. And obviously we're a lot higher now, right? But it's one of these, so it's definitely, I think, in our client conversations, it's becoming a really big issue. But it's one of these things that you just can't really figure out, like, for me at least, like, you know, when does the market really sort of have a nonlinear point of repricing? Is it at 100% of GDP, 130, 150, right? That's what we're struggling with.
And it seems like November doesn't help.
Yeah, November does not help, yeah. Okay, we'll leave it there. Thank you very much. I think lunch is being served.